Okay, everybody. Thank you for joining on this installment of Mortgage Mondays with Manny. This is being recorded. I don't know if you got something on the line, but I do record them. I do put them on YouTube because there are some people that cannot make it. So I do get more views on YouTube as well. And you can always reference back to it if you did not record it. You know, you could always go to our YouTube channel that has it. You know, just Google the Accredited Group YouTube, and that's what they are under. So tonight's segment, again, I know I've done it a few times, but it's a forever moving target on DSCR loans. Okay. For those who don't know, DSCR loans are loans that just in the simplest way I can describe it, they use the income of the property. That's it. Closest thing to a no income or no documentation loan, for some of the old veterans on here, closest thing to a no documentation loan as we can get to in this day and age. Okay. With that being said, team, I'm going to share my screen. We do have a slideshow presentation. Again, start filling up the Q&A as you go along. There's no such thing as a silly question. Okay. I'm the only one that can see it. And I will answer it to the best of my abilities. And it's good. It helps the group grow. So let's get involved. Let's get ask questions, get knowledgeable on this product. I know you guys do a lot of it. Everybody's asking, I need more training. I need more of this. Well, this is it, guys. This is our most popular product by far. So you want to learn it and you want to, do lead generation for it. Okay. With that being said, I'm going to share my screen. Okay. So we are now sharing my screen. So Merchants Property Solutions, that's us. Okay. This does fall in the non-QM family, guys. All right. So it's a non-QM family loans, which means it's not a qualified mortgage. It doesn't go to Fannie Mae or Freddie Mac or, any of those normal cast of characters that buy loans. Okay. So what is a DSCR loan? A debt service coverage loan, DSCR mortgage, is a type of loan that is based on the borrower's ability to generate enough cash flow to cover the debt payments. The DSCR is calculated by dividing the property's net operating income, NOI, by the total debt service. Payments including principal interest on the mortgage loan. Now, guys, if it's a 4-unit or anything over 4 units, it's the same thing, 5 units plus. We do take into account common areas. We do take into account garbage removal, true expenses that it costs to run a building. All right, because at that point, 5 plus, you're considered running a building. Okay. As you can read in the bottom there too, its mortgage is often used to finance income-producing properties. It's always used to finance income-producing properties, such as commercial real estate where the borrower's income is generated from properties rent. The lender uses DSCR to assess the borrower's ability to repay the loan and ensure the property generates enough income. Yes, team. So I'm going to go over the key highlights, and then we're going to go over DSCR ratios. All right. But again, any questions, just start popping them in there. All right. So what are the key highlights? I said the previous slide. Income is derived from market rent. Analysis done by the appraiser. So when I get the appraisal, I ask for 2 numbers, team. All right. I ask for the appraised value, which what do they think the property is worth. I also ask for the market rent when we order these appraisals. Hey, Mr. Appraiser, also analyze the market rent. Let me know what could be gotten as far as rent on a monthly basis from this. Now, if you have and we'll get to the Airbnbs in a second, which is a whole different ball game. So no DTI is calculated. Okay. We don't use the borrower's income. DTI stands for debt to income ratio. All right. We do not figure out that ratio. Why? Because we're not using the borrower's income. The ratio we use is called a debt service ratio, meaning is the debt serviced by the income? That's the underwriter's question, and that's what we use. Okay. Max LTV is 80% on the purchase and ringing term refi, not in the primary, guys. I'm sorry. That's a typo. There is no primaries. You cannot do primaries on this. I will fix that. Max is 70% LTV on a cash out refi. Sometimes I can go higher, provided the borrower has a good FICO score and other compensating factors. I can ask for an exception. 620 minimum FICO to get into this program. Okay. No tax return required. Now, short-term rentals acceptable, Airbnb, VRBO. So those come with a couple of little asterisks, team. All right. So in the areas, and I'm going to use what's the area that's close to me that some of you may know, may not know, there's summertime places. Long Island is very summertime driven. Out east where the Hamptons is, where Montauk is, there's properties that don't rent out during the year. They make all their money from Labor Day to Memorial Day, and hence an Airbnb. So there are ways to use that income because, for example, if I asked my realtor for data on a monthly rental for a Hamptons property, that's maybe on Dune Road or in Montauk close to the beach, there's no data for monthly rentals. Very rare. Okay. It's difficult to get. Are there some out there? Yes, but not enough to derive a full market analysis of rent. There are a lot of areas throughout the country on that. Some of the Gulf Coast, some of the, some places in Cali. Tennessee is a very big Airbnb place right now as well. So those places that don't have market rent and are doing an Airbnb, it's a different way to prove income, and we take them on a case-by-case basis. Usually, though, team, the LTV is lowered a little bit. So, for example, if I can get away with 20% down on a normal monthly rental, I would go to 25% down if it's an Airbnb. Okay. Usually has to do with when it comes to purchases, because we still ask for the market rent. But if it's not covered again and we have to do Airbnb, we would need to prove what they're getting from the Airbnb. Okay. And there's many ways to prove that. Once you guys have a deal that we send in at Airbnb, we'll ask the borrower what we need as far as to prove income. All right. 100% gift funds allowed. That's huge, guys. Let's say a person's buying a mom or dad's house from a family member, or let's just say it might be a friendly sale, or let's just say the seller knows they're selling it below market and they just want to get rid of it. They'll do 100% gift funds. Let's say mom and dad, or there's an investor. Let's say there's two investors. One investor has a low credit score but has the cash. One investor has a good credit score but no cash, and they're combining. Investor A can gift to investor B. It does not have to be a family transaction for me to use gift funds. So that's a good way, to get almost not 100% financing because you're putting money down, but it is a way to, get funds that they don't have if they want to collaborate with somebody. All right. Next one, only 50% of ownership needs to sign. What does that mean? If I close 10,000 DSCRs, 980 of them, or 9,980 are in a corporate name. Now, sometimes the corporate name, when it's refied, at least 50% of that corp has to sign the loan documents. All right. So they need to know that there's a loan being taken on the place. So at least 50% needs to sign when it comes to vesting. Okay. Rural properties. This is huge, guys. Since I'm the bank, a lot of people who do DSCR loans will not do rural, but I'm the bank. We take on the risk. We've decided to do rural properties within a certain reason. They're capped at 75 loan to value. You can only have, at least 10 acres. It's not harder to do, but there are some restrictions for it. We do a lot of them now too, that we can, do rural properties. No modular or mobile homes though, guys. No investment properties. I don't know any investor that does them unless it's a conventional loan you can prove income. But on the non-QM side, I do not have any programs for for a modular home, especially it's rural. Okay. No sourcing or seasoning of down payment. As long as you come to that table with a certified check for your down payment and closing costs, we're good to go. Has to come from a bank account we approve though. If we approve bank account, 1, 2, 3, 4, 5, 6. That certified check or wire needs to come from account 1, 2, 3, 4, 5, 6. Okay. Can close in the name of an LLC. This is not any legal advice, but you'd always want to close an LLC to protect yourself. All right. It is an asset. You want to protect yourself. Again, I'm not a lawyer. This is not legal advice. I'm just telling you what my clients do. Again, as I told you, if I close 10,000 of these, 9,980 are in a corporate name, whether it's an LLC, a corporation, an LLP. They are in a corporate name and not the personal name. We can do ITINs, which is pretty much a tax identification number for an individual who's not fully documented in the United States to pay taxes on the income that they make. We can do that, and we can do foreign nationals. For example, somebody out of the States, Canada, Mexico, which is very common, buying an investment property. Some of them are buying summer homes here, believe it or not. Especially from Canada, where it's really cold. Summer is very limited. We do have some Canadians buying, did a bunch in Florida, like I said, Tennessee, Gulf Coast, in Alabama, where it's cheap, and still beautiful. So we do a lot of foreign nationals in this program. Interest-only options are available, and 40-year terms. I do that together because here's how it works. You have an interest-only for 10 years. So your first 10 years is interest-only. Then you have the option to make it a 20-year loan or another 30-year loan. So those are the options. So that's how we get to a 40-year terms. First 10 years interest only. The next 30 years, you then start paying back principal and interest. And that interest and principal, after that 10 years, you would decide at closing what you want, but you can either do a 20-year loan or a 30-year term. After that interest only period, which on both loans, it is 10 years. Okay. Available in all 50 states plus District of Columbia. Okay. Since it is a business purpose loan, we just need to be licensed as a bank. Okay. We are licensed to do primaries and second homes in 39 states. When it comes to investment properties team, we could do any state plus the District of Columbia. Okay. So that's 51 different territories we can do. Now, I know you guys are going to ask, can you do Puerto Rico? Can you do the U.S. Virgin Islands? No, we cannot right now. We do not have any outlets for that. First-time home buyers and first-time investors are okay. There's really sometimes you have to a little bit lower. They do want a higher credit score since you haven't done it. Sometimes a little bit more money down. But if you are a first-time home buyer, that is okay. That is something that makes us different. You're allowed first-time home buyers. All right. So again, those are the key highlights, team. Tells me not paying attention. If I got no questions, throw questions in there as you have them. All right. I'll answer them afterwards. Let me know what's on your mind. Okay. Occupancy types, investment properties only. Okay. You're not living there, intended to generate rental income and or appreciating value over the time. Again, strictly investment properties. If you say you're going to live there part of the time, that would be a second home. If you say you're going to live there all the time, that is a primary residence. Again, primary residences and second homes are not eligible for this product. How to calculate a DSCR. Okay. It's not tricky, guys. It's not rocket science. Don't have to be the best in math as long as you have a calculator. All right. So what do you need to know to calculate the DSCR? First thing, number one, you need to know what the expenses are. Okay. And expenses can be included depending how many units it is. Include everything from, if it's a 1 to 4 family, I'm just using the PITI, which is principal, interest, taxes, and insurance. That's up to 4 units. If it's, usually 5, anything 5 plus units, they delve into a little bit more expenses. What does it cost to run the place? What's the electric for the place in the common area? Because usually there's common areas for those of you who might live in an apartment building. There's a basement. There is common areas like halls, elevators, lobbies, or vestibules, some of you may want to call them. Those are other expenses that we add into usually in 5 plus units to figure out the debt service ratio. Okay. Now to calculate the debt service, calculate the monthly debt service. In this case, I'm going to use a monthly debt service total PITI payment, which is $3,000. Now calculate the monthly net operating income. To do this, you need to calculate the gross rental income, subtract monthly expenses over the debt, and you guys can read that. Debt service is $1,000 a month, so the monthly net operating is $4,000 minus $1,000, so that equals $3,000. So then you take the $3,000. So you got your monthly. Oh, sorry, guys. So you take your monthly net operating income, guys, and then you divide it by your monthly debt. In this case, 3,000 divided by 3,000. Okay. If it's a 4 unit, like I said, you don't have to do the net operating income. You pretty much use all of that income because we're not using other expenses. That net operating income comes, like I said, 5 plus units when there's more expenses. But in this case, for all intents and purposes, again, we could say it's a 1 unit. Maybe it's a 1 unit that's getting that much, which is not out of the range to get 4,000 for a rental property. Just one unit nowadays, single family. Now, a DSCR of 1.0 is good. You want to see the 1.0. Okay. Now, anything, a 1.0 above is gravy. You do get better rates if it's the 1.25 factor, meaning you're making money on it, 25% over. And then a 1.50 is like the holy grail. You are, crushing it on your income. You're making 50% of over what the payments are. So it's really good. I shouldn't say the holy grail are a lot, but that's like really good for an investor, a 1.50. The average I'm seeing is a 1.25. Okay. So it's good. People leaving cushions for when taxes go up, or if other expenses go up, if the boiler breaks or something, whatever the case may be, they have cushions to service the building, to service the debt, and make a little money to put in their pocket. Because at the end of the day, that is what is wanted. Okay. Now, keep in mind, I do have products if the DSCR is less than 1. Some other companies don't. A lot of my competitors are really good, but they don't have the 100% gift funds. They don't have the DSCRs under 1. A lot of them need 1.2. I can go down to sometimes a 0. I can go down to a 0.25 DSCR. I'm actually closing a few right now that are 0.5 DSCR. Yes, they had to put down more money, 30% instead of 20. Yes, they needed a little bit higher credit score, 660 instead of a 620. Okay, it does come with a couple of different things, guys. The program is a little bit different, okay, as far as guidelines, but it's still out there. You could still get less than a 1-to-1 ratio. Doesn't have to be even close to 1. 0.25, that might be your Airbnbs out there. Market rent is $2,000 a month, and you're going to get $10,000 a month from your Airbnb, and your mortgage payment's $5,000 a month. Again, I know that's not 0.25, somewhere around there, but you guys know what I'm getting at. If it is the market rent is lower, that's how we determine sometimes with the Airbnbs. We put it in a lesser program. Okay, where the debt to income ratio or the DSCR ratio does not have to be that 1-to-1 ratio. All right. Again, guys, put some questions in there. I'll answer whatever you have. So this is me. Okay. Hit that take a picture of that little square. That will give you all of my information to contact us. All right. This is going to be posted on the YouTube channel as well for those of you who are paying attention but not paying attention. Okay. I know I have ADD personally, so I might go in and out sometimes in some seminars, but I do refer back to them, when they're recorded. So this will be recorded. Okay. I do see a question. What do we got here? Is there a typical client you see for these loans? No, I do not see a typical client. Jeff, I see all walks of life, all different genres, all different buying this, from first time investors that, 18, 19 years old, they've gotten some money from being hustlers, to your 7-year-old investors, to, people looking to get cash. It's all over the board. It's who's ever looking to buy an investment property. And again, what's appealing, if people have a little bit of money saved, we can, get them into investment property. But I will do this because I didn't put it on my slides, or we'll pull it next time. There is loan limits on this team. Depending on the state, it's anywhere from 75 to 200,000. Okay. Do you use the actual rent or what the appraiser determines is market? Okay. Hey, Dave. So we can use either or. Okay. Sometimes if the actual rent is more than the market, there's ways to use that. Okay. But if it's off a little bit, and again, the DSCR doesn't have to be 1-to-1. Let's say the market rent still works, still puts you in the same program. Let's say you're getting 2,500, market rent is 2,000, and the loan still works. I'm not going to ask you to prove anything else, because why show more if we don't have to, but if you're getting 5,000 or 6,000, and the market rent comes in at 3,000, we have to prove why you're getting so much more money. Is there 2 apartments in there? Is one illegal? Are you stuffing the hell out of it with there's safety issues? Did you convert the garage, the basement, and the upstairs all into a market? It is going to raise questions. So my answer is yes, we use it all depends on the program, and if I know going in hand, or beforehand, what route I need to take, I can put it in the proper program, because we have programs for both. Okay. Most of the time people rather use the market rent. But again, it's, it's again, I have tons of programs. From a marketing standpoint, who should we market to? REA members, real estate agents, etc. Anybody, CPAs who people want to buy it, just put it out there. There's people, guys in construction companies love, not that I say, but I see a lot of construction guys. They love buying investment properties because they can get the fixer-upper, as long as it's somewhat inhabitable, but they can get that fixer-upper and they can put money into it. So we get a lot of construction guys that are doing our fix and flips and doing these investment properties, but don't just limit it to one. There's no secret sauce to what kind of investor. Okay. I love CPAs personally. Real estate agents I like working with too, but they always have their person. But you can advertise it to everybody. I never want to, shy away from a demographic, because you might be surprised who buys this. You have people that just live off rental income, that sometimes their bank may go out, or their bank tighten guidelines in this market. Their local bank stop doing it. Maybe they're getting so big with their rentals, they need to take losses, and they have to go from a full doc program to a DSCR program. because they're getting really big and then, it's all about what you keep. So they're taking more write-offs because they have 10 finance properties and you can't go Fannie Mae anymore with 10 finance properties. You have to find an alternative method. So I don't think there's anyone best. My answer to that, Christian, is you'll be surprised who responds to these things. Again, everybody does, So just throw it out there, play with your marketing, pay attention to your analytics, and now will help answer that. But for me, from a standpoint, with all the leads I get, it's very well spread out across everybody. Okay. What else we have, team? Anything else? Okay. Again, team, DSCR loans, just to recap, don't need a 1 DSCR. So a 1-to-1 ratio can go lower. Obviously, higher is preferred. That's how you get preferred rates, lower LTVs. 620 minimum to get into the program. 80 LTV on purchases, 70 to 75 on refinance cash outs. All right. Rates are all over the map. For anybody who wants to know, they're all over. We price them one-on-one. Remember, guys, I'm the licensed loan officer. I need to, deliver the rate. That's the one thing we are adamant about. Even though our banking system allows us to do it, I still want to talk rate to the client because there's a lot of things that go into it. And I don't discuss rate till I have all the particulars. Okay. Anything else, guys? Going once, going twice. If we don't have any more questions, I'll let everybody get back to what they were doing. Thank you for your time as usual. I'm still sharing my screen. If there's anything else you guys need, all of my information's on there. Like I like to say, I'm not the Prince of England or, the Prince of Wales, whatever you want to use. I do not need a formal invitation to get in touch with. If I can answer, I will. If not, I'll get back to you as fast as humanly possible. Okay. Towards the end of the month, it's a little not harder. My times are a little bit lagged just because at the end of the month, I'm trying to squeeze in loans for monthly numbers. But again, text me, email me, call me. If I'm up late at night, I'll answer. Sometimes I am that quintessential New Yorker. We do not sleep. We do not rest. However, give it a shot. I may answer. You never know. Most of the times I will. If sometimes if I answer, throw me a text. It might be easier for that way. If it's the weekend and I'm at a function or late at night, I still do go to marketing events, guys. So if it's after hours and you don't get me via phone, if you call, email me, text me. Most likely I can answer. Okay. Like I said, thanks everybody for coming on. Next Monday, I'll put it in the chats and however else you guys get in touch with me, I'll let you know what I'm announcing next week. If you have any ideas of what you want me to go over too, guys, email me personally, text me, whatever. Let's do a consensus of what you guys feel you need some training on, and I will work that into our program sequences. All right. So everybody have a great time. Enjoy the rest of your evening, and speak to you all during the week. Let's keep those leads coming, team. Thank you.